Welcome to the Deep Dive. You've sent us the sources on one of the biggest recent moves in enterprise software, and we are ready to peer into it.
We are. Today, we're looking at the take-private acquisition of Jamf Holding Corp.
That's NASDAQ, ticker JAMF. This is a huge deal. We're talking about the company that basically defined device management for Apple in the enterprise.
Exactly. And this deep dive isn't just about, a big price tag. It's about what happens when a profitable, fast-growing tech leader goes from public back to private.
Right. So our mission today is to distill the financials that made Jamf such a target, understand the pretty aggressive price Francisco Partners paid, and then unpack what this all means for the market.
Let's start with the hard numbers. The announcement came on October 29, 2025.
And this is Jamf being acquired by Francisco Partners, or FP.
That's right. It's an all-cash deal, valuing the company at approximately $2.2 billion.
Okay, so for the shareholders holding the stock, what does that break down to? What are they getting?
They're set to receive $13.05 per share.
And how does that compare to where the stock was trading?
Well, this is the key part. That price is a massive premium, about 50% over the average closing price for the 90 days before the deal was first hinted at.
50%. That's an eye-opening number.
It is. It tells you two things, right? First, Francisco Partners really wanted this asset. And second, maybe the public market was significantly undervaluing Jamf.
So for investors, what's the timeline here? When does this all finalize?
The closing is expected in the first quarter of 2026. It just needs the usual regulatory and shareholder approvals.
And that shareholder vote is scheduled for January 8th. Any real doubt about how that's going to go?
Not really. I mean, the deal already has major support locked in. Vista Equity Partners, the largest shareholder.
And on a huge chunk, right?
A huge chunk, 34%.
Yeah.
And they've already agreed to vote yes.
And they're cashing out completely. It's a clean exit for them.
A very clean exit. And on top of that, you've got management aligned. The CEO, John Stroessel, and the former CEO, Dean Hager, they've also committed their shares.
So this is not a hostile takeover. This is a planned strategic move.
Very much so.
Okay, before we get into the private equity thinking here, let's just set the stage. Who is Jamf? What did they build?
For 20 years, they have been the gold standard for managing and securing Apple devices inside organizations.
And when you say organizations, you mean everybody?
I mean, their client list is just a who's who.
Huh.
Top universities, major U.S. banks, huge school districts, the best hospitals, and of course, a ton of Fortune 500 tech companies.
So if your company runs on Macs and iPhones, there's a good chance Jamf is in the background.
A very good chance, which is why their growth, even before this deal, was so impressive. This isn't a story of a struggling company getting a lifeline.
No, this is a story of a company hitting its stride.
Absolutely. If you look at their numbers from fiscal 21 to 24, total revenue grew at a 20% compound annual rate.
From about $366 million to $627 million.
Right. But the really important number, the annual recurring revenue, the subscription money, that grew even faster. A 24% CAGR, hitting $646 million in 2024.
So the growth was there. But analysts always want to see efficiency, right? Margin expansion. What did they do on that front?
And this is where the story gets really critical for the acquisition. They moved from just high growth to being a mature, profitable engine with stunning speed.
Okay, so break that down.
Their non-GAAP operating income margin went from just 6% in fiscal 21 all the way up to 16% in fiscal 24.
16% is solid. But the real rocket fuel was just before the deal, wasn't it?
It was. If you look at adjusted EBITDA margin, that went from 7% in 21 to 18% in 24. But then in the first quarter of 2025, it surged to 24%.
24%.
24%. And on top of that, they hit GAAP profitability in that same quarter. A small net income of $1 million, but that's a huge swing from a $21 million loss the year before.
So they're performing incredibly well by any public market standard. And yet the CEO says they're going private for greater financial flexibility to accelerate growth.
That's the official line, yes.
Yeah.
But you have to ask the question, right?
Yeah. I mean, if you're already posting a 24% EBIT margin and you just hit profitability, how much more flexible do you need to be?
Exactly. It suggests that while the story is about growth, the real goal for Francisco Partners is probably more about immediate aggressive profitability extraction. They had to justify that price tag.
Let's follow that. Let's do the math. They're paying $2.2 billion for a company that did about $110 million in adjusted EBITDA in 2024. What does that multiple look like?
You're looking at an implied valuation of roughly 20 times EBITDA.
20 times. An enterprise sauce, that is.
Right.
That's a top-tier multiple. That's not cheap.
Not at all. It's aggressive. Usually you see that for, younger companies with much higher growth expectations.
So what does paying 20x demand from the new private owner?
It means they can't just keep things as they are. To get a return on that $2.2 billion, they have to find ways to drastically increase profits, and fast.
So this isn't a buy and hold, it's an optimization project.
That's the classic playbook. You're looking at intense scrutiny on costs, maybe cuts to R&D, and definitely more aggressive pricing strategies.
Okay, that brings us to what they actually bought. What are the key drivers that made Jamf a $2.2 billion asset?
Two main things. First, you have to look at their customer mix. The engine of this business is the small and mid-market segment.
Companies with fewer than 2,500 employees.
Right. And that segment accounts for a whopping 62% of their total recurring revenue. It's a huge, sticky customer base.
And the second driver is their move into a new market.
Yes, their pivot to security has been a massive success. The security cross-sell efforts have really paid off. Their commercial security ARR jumped from $61 million in late 2021 to $142 million by the end of 2024.
So they're not just a device manager anymore, they're a security platform.
And that justifies much higher prices. It's clear why PE was interested. And this deal fits a broader trend we saw in Q3 2025.
Right. There was a big surge in private equity buyouts in the software space.
A huge surge, a 26% quarter-over-quarter jump. The big money is hunting for these mission-critical platforms with high recurring revenue. Jamf is the textbook example.
Find a leader, leverage it, optimize it, and then aim for an exit in, 5 to 7 years?
That's the private equity thesis in a nutshell.
Now, there's one small financial detail I want to touch on about the stock options. It's a bit in the weeds, but it's important.
Yes. So while public shareholders get $13.05 a share,
right,
the settlement for management stock options is actually a little higher. It's $13.50 net cash per share.
Why the difference? Why give management a better deal?
It's all about aligning incentives. It's a pretty standard tool, actually. It ensures management is fully on board with the transition and, with the tough decisions that might be coming.
Like the aggressive cost cutting needed to justify that 20x multiple?
Exactly. It ties the key insiders to the success of the new private company. It's a subtle but really important piece of financial engineering.
It really is. So Francisco Partners says they'll keep the name, keep the headquarters, support the next phase of growth, but the market is bracing for what comes next.
Because historically, this kind of buyout leads to concerns. Aggressive cost-cutting, maybe service quality suffers.
And that risk is especially high when 62% of your revenue comes from that smaller, more price-sensitive customer base.
Precisely.
Okay, that wraps up the analysis of the deal itself. But before we go, we have to talk about what this means for you, the listener, watching this space.
And first, of course, we have to start with our standard reminder. The information we're talking about here is for educational purposes only. It is not financial advice.
We are not your financial advisors. Please don't take anything we say as a recommendation to buy or sell anything.
Okay, disclaimer done.
Let's talk strategy. If our thesis is right that FP has to squeeze this thing for profit, that probably means price hikes and maybe service changes for Jamf's core customers.
Which creates a massive opportunity for their rivals.
And it's an opportunity that's easier to exploit than ever before because of a key change from Apple.
This is the real game changer. It used to be a complete nightmare to switch your MDM provider. You'd have to wipe every single device and start from scratch.
A huge project for any IT department.
Huge. But now Apple allows MDM migrations without a device wipe. That dramatically lowers the barrier to switching. The cost, the risk, it's all much lower now.
So with that in mind, what's the outrageous but plausible trade idea here?
A long position on a growing, aggressively priced rival MDM platform. Specifically, a company like Mosul or Adigy.
And for context, Mosul and Adigy are known for going after that same small and mid-market segment with really competitive pricing. The exact customers Jamf relies on.
Exactly. The bet is that the financial pressure from this $2.2 billion deal will cause Jamf's core SMB customers to start looking around.
And they'll find these lower-cost, capable alternatives waiting for them.
You're basically profiting from the risk that short-term financial extraction will trump long-term customer loyalty. You're betting on the churn.
It's a fascinating angle. So to recap the whole story, Jamf, a clear market leader with fantastic financials, 24% ARR growth, 24% EBITDA margin, is going private for a very aggressive $2.2 billion.
And that move swaps the pressures of the public market for the arguably more intense pressure of needing to deliver a massive return to a private equity owner.
Which leaves us with the final provocative thought. Given how competitive Apple MDM is with rivals like Mosul, Kanji, and Adigi already out there,
and with the technical barrier to switching now gone, can Francisco Partners actually pull this off? Can they implement the cost measures needed to justify 20x valuation without destroying the very customer base that made Jamf a one-of-a-kind company in the first place?
or have they just created the perfect opening for their competition?
That is the question to watch.
An essential dynamic to monitor in the enterprise software space. Thanks for tuning into this deep dive. We'll catch you on the next one.